Hey, well, welcome to the Buff Show. Today we got me and Kade. We're going to go over mortgage insurance.
Yep.
This is a good one because I get this one a lot. I guess let's start off with what is mortgage insurance.
Yeah. So, well, I mean, you're going to get a better answer from a lender than what you're going to get from me, but it's basically the investor who is placing an insurance policy on the loan that you'll pay the loan back, essentially.
Yeah.
Right?
It protects the lender, really.
Mm-hmm.
So mortgage insurance, you typically have to pay it on the loan if you're less than 20% down.
Correct.
Or if you're getting an FHA loan. FHA loans have MIP, right? Correct. Is that what they call it?
Yep, MIP.
And that is, if you're doing an FHA loan, that just stays on that loan for the life of the loan. There's really no way of getting out of that.
Yeah, the only way to get rid of MIP from an FHA loan is you actually have to refinance to a conventional loan or a different type of loan to get rid of it.
Yeah, but if you're conventional, you have some options to get out of what they call private mortgage insurance. Mm-hmm. And so, let's run through some calculations on how much mortgage insurance is, because it's pretty, it's surprisingly high. So like if you do like a $400,000 loan amount, they're saying it's about 0.5%. So your monthly PMI payment, in addition to your mortgage, would be $166.67 roughly. Mm-hmm. Again, that's probably going to vary a lot from lender to lender. That adds up over time.
Right.
And lenders have a rule that they say if you have at least 78% debt to equity in your house, meaning you would be at what's that?
If your purchase price on the house is $100,000,
yeah,
but you have a loan for $78,000 or more, you would have mortgage insurance.
Right. Correct.
Yeah. So if your debt,
I think you'd have to do 20% down if you're going to get out of it.
Right, but I'm saying for them to automatically drop it,
right,
you have to be at. If your purchase is $100,000.
Well, let's just say if your loan is $100,000, not purchase.
Well, it's off of the purchase price. It's 78% of the home's value. Is when they'll drop it. So if the home is purchase priced at $100,000,
right, and let's say you put $5,000 down,
and you put $5,000 down,
and so you owe $95,000.
Correct.
You have to get under $78,000 of equity before they're going to drop it, right? So you need to pay it down enough to where you get below the $78,000 mark.
Yes.
And lenders will drop it automatically at 22%, which is kind of crazy. But if you catch it early, you can call them and say, "Hey, I'm at 20% here. Let's get this dropped."
The cool thing is this I didn't know actually till today, but your typical amortization schedule, basically that's how much you're paying of interest and principal every month. You're going to pay it down if you're making the minimum payments anywhere between 11 to 12, 13 years.
Yeah.
And that's a long time to make that, $160, $200 payment every month. But if you watch the market or you stay on top of it with your agent, you can also count the equity gain in the property.
Yep.
And so that would be something you'd want to watch, because if your property gains equity just because the market's appreciating, that can count towards that 20% gap of your loan to value.
Yeah. I'll bet if we were to go out there and analyze, say 100 homes in Utah, I'll bet there's a ton of people paying mortgage insurance that don't need to be paying it, right? Because a lender will automatically remove it once you've made payments until you're under that 22%. But that's not including appreciation.
Right.
Or additional payments. So, I mean, maybe they'd include additional payments if you made them. I'm not sure. But that takes 10, 11 years. But so the kicker here is if you think you're over that 20% equity, you need to ask your lender what they require to get out of it, because there's multiple lenders and service providers, and they're all going to kind of have a slightly different approach.
Yeah. I had my brother, he reached out to me. They built a house in 2020. They built a home in 2020. Might have been 2021. I can't remember. It was kind of during the big market boom a little bit, I guess. And so they built their home, and he reached out to me last year, and he said, hey, I'd like to see if we can get rid of PMI. What do you think? And so what I started doing for him is I pulled comps on his property, basically sent him a CMA, figured out what he bought the home for, how much he put down, and then I said, okay, based off comps I'm pulling and seeing, I'm estimating your home's value to be X amount.
Mm-hmm.
Based off of that X amount, based off of how much cash you put down, because realistically in your first 2-3 years of owning a property, you're not paying much principal down.
Right.
You're probably going to pay, I don't know, $5,000, maybe less. I don't know. Not much. And so I just took their down payment, subtracted that from their total purchase price, and then that difference from the total new value that I have, and told them, yes, I think you guys would be good to go ahead and call your servicer to see if you can drop your PMI. And so they did. They had a conventional loan, so they didn't have an FHA loan. So they called their servicer, and with theirs, because that equity gain from 2021 to 2024 was so big, the servicer didn't make them do an appraisal or nothing.
Really?
Yeah.
So did they just send the report that you sent them?
They sent that report in, and then the servicer basically was like, it's pretty apparent that with how much you guys put down from the beginning, plus where you're it's likely that your house is at, that you're above that.
Do you remember what it saved them a month?
It saved them, I think it was close to $200 or $250 a month.
Really? Dude, that's crazy.
Yeah. So it's a
considerable amount.
Yeah. It's enough to make a difference, you know.
For sure.
And everybody is so, you know, like the rates. We can buy down the rates to make the monthly payment lower. But this is another option you have, that if rates haven't come down yet, you still may be able to make your monthly payment quite a bit lower.
Yeah, for sure. And to get just to get out of that.
Mm-hmm. An appraisal might cost you $400, $400 to $600
probably. Yeah.
Mm-hmm.
Or, I mean, every lender's probably going to have a different process. Some might require formal appraisal. Others might do their own like desktop appraisal. Others might take comps from an agent. But I think the first thing is checking homes in your neighborhood. Do you feel like the value is you're at least 20% equity on what your debt to your equity is? And then we can help you with that. And I think if you just reach out to an agent, one of us, and we can run comps and see what the homes are selling for in the neighborhood. And if it looks like you have 20%, then I'd send that over into your lender, say, hey, here's what we got, and then see what their process is like from there.
Bring it up. Like, we have a house that's selling in our neighborhood. We just built in 2024. We just closed in October. We have a house selling in our neighborhood with an unfinished basement. We have an apartment in our basement, and we're under contract as last listed at $625. And so I'm really interested in to see what that house closed for.
Yeah.
Because if that one closed for anywhere, in my opinion, close to $625, like, our value in our home has gone up a little bit.
Right.
And which would be awesome. Then we could, we have mortgage insurance on our house, and so we would be able to, maybe take probably $200-$300 off our loan every month.
Right. That'd be huge.
Yeah.
Yeah, so that's I think there's a lot of people out there, again, with that are paying additional money that they don't need to on their mortgage. So everybody should go and check their mortgage statement, see if you have PMI on there, see what your debt to equity is. And realistically, if you feel like you're 20%, then get with us. We can help you remove it.
If you bought a home before 2020, and you're still paying PMI, you can get rid of it. Unless you've refinanced recently or something like that. If you purchased a home before 2020, I would be so surprised that you can't drop PMI as of now.
Yeah, for sure. Yeah, if you bought since 2022, it's probably like iffy.
Pretty iffy.
Yeah, but still, we can look into it and see if we can get you out of it. So I think this is a podcast we should have done a long time ago, because I think it would save
a lot clients' money, or even just a lot of homeowners. For sure. Realistically, there's a lot of people out there that I'm sure are paying it that don't need to be.
Yeah, that don't need to be. Just like I went to, on my phone bill, AT&T, I was like, Kade, how much are you paying for your phone bill? And I was like, $100 more a month. And we went in there, and they're like, "Oh, well, it's because you have your auto payment set up with your credit card. You need to switch that to just like a bank withdrawal, and that'll save you like $40 a month or something like that." And I was like, "Geez, that's crazy."
Yeah,
like,
you just get busy. Life is just busy, and you just
Yeah.
don't even think about it.
right?
But if you can pocket an extra couple $100 every month, that'd
For
be
sure.
nice.
Yeah. So hit us up if we can do anything to help you out there. We'd love to. And thanks for watching. Till next time.
Yeah. Thanks, guys.